You had to earn about $39,000 a year to afford the average home in the US. That was in 2012. Fast forward to November 2024, and that number has jumped to over $126,000, a 223% increase according to Redfin. The reality is it's getting harder and harder for people to afford a typical home. Many first-time buyers probably wish they could rewind the clock to when both home prices and mortgage rates were much lower. Take a 3-bedroom Victorian-style house in Chapel Hill, North Carolina that the Wall Street Journal profiled. It looks almost the same as it did when it was built in 2010, but the price tells a different story. It's now listed for $520,000, more than double what it sold for back in 2011. See, if you put 20% down, your monthly mortgage payment would be around $2,800 at today's interest rates. That's nearly triple what it cost in 2011, and that's before factoring in higher property taxes and insurance, which have also gone up massively. For years, the American dream was pretty simple.
The American dream.
The American dream.
American dream.
Work hard, buy a house, raise a family, and enjoy a comfortable retirement. But today, that dream feels like it's slipping further away as costs keep rising and wages stay stuck.
Saving the American dream. Thousands of striking auto workers hold up signs with that slogan.
Back in January 2012, a typical American household needed that about $39,000 a year to afford an average home. That number has now shot up to over $126,000. In 2012, the median household income was $51,000, and by 2023, that had climbed to $74,580, a 46% increase. When you adjust for inflation, wages haven't really improved at all, and mortgage rates are making things worse. See, in 2012, you could get a 30-year fixed mortgage at about 3.6%. By late 2024, that jumped to about 7%. So that once manageable mortgage payment is now out of reach for many people, making home ownership feel more like a luxury than a cornerstone of the American life.
Middle-class Americans says life has quickly grown unaffordable.
Home prices have surged way past what people can afford. Back in 2012, the median home price was $180,000. By 2024, it was more than $420,000, more than doubling in just over a decade. And a lot of this is due to factors like limited housing supply, big companies snapping up property, and the rising cost of construction and labor. And renting isn't much better. In 2012, the average rent for a 1-bedroom apartment in major US cities was around $1,000. By 2024, that more than doubled to $2,000. With rent eating up over 50% of income in some urban areas, saving for a down payment feels like an impossible dream. And young Americans, especially millennials and Gen Z, are postponing home ownership maybe forever. Student loans, high living costs, and a job market that doesn't offer the same long-term security as it did for their parents have made home ownership feel like a distant goal. The gap between homeowners and renters is widening, leaving many feeling financially unstable.
For the third straight month, prices have gone up more than expected.
Okay, but housing isn't the only thing that's costing more. The price of everyday essentials has skyrocketed too.
What do these cost? $2
This was $200.
We supposed to skip the power bill this month so we can buy groceries or the mortgage?
Just look at groceries. Between 2020 and 2024, the USDA reported a 25% rise in food costs, with basic items like eggs, milk, and bread nearly doubling in price due to inflation and those supply chain issues. And then there's healthcare. In 2012, the average annual premium for family health insurance was $15,745. By 2023, that had gone to over $22,000, forcing a lot of families to cut back on everything else just to pay for their medical costs. Then there's education. Back in 2000, the average student loan debt was about $17,000. By 2023, that number had more than doubled to $37,000, leaving many young people financially strapped well into their 30s. With so much of their income going to cover these costs, saving or investing for the future feels out of reach for many.
Thank you very much, everybody. Well,
It's not just inflation that's a problem here. Government policies have played a big role too. There's been low interest rates and corporate investment in housing. See, for years the Fed kept interest rates low, encouraging big corporate investors to scoop up homes and turn them into rentals, which drove prices higher than what most people can afford. Then there's wealth inequality. Tax policies have benefited the wealthy, letting billionaires amass fortunes, while middle-class wages have mostly stayed flat. As of the latest data, the top 1% owns over 32 82% of US wealth, and the bottom 50% control just about 2.5%. Then there's the minimum wage issue. The federal minimum wage has been stuck at $7.25 since 2009, while the cost of living has surged. Even in states where the minimum wage is higher, it's still not enough to keep up with rising costs. Now, a lot of companies don't actually pay minimum wage because no one would take that rate, but you can start to see how just symbolically this being there is a problem.
The American dream changed, or the American dream debt just completely changed.
With financial stability becoming more and more out of reach, attitudes about work and home ownership and wealth are shifting. More and more young people are opting out of the traditional career path. Freelance work, digital entrepreneurship, and even living in vans are starting to look more appealing than the pressure of trying to buy a house and live up to an outdated version of the American dream. Many people are questioning if home ownership is even worth all of this financial strain.
A house is one of the dumbest, worst investments a human being could possibly make.
It's also taking a mental toll. Financial stress is a major cause of anxiety and depression, and younger generations are experiencing burnout at higher rates than ever before. The pressure to achieve what used to be the standard American dream is leaving many people overwhelmed.
That marks a dramatic shift from what this growing trend means for youth.
This economic shift is having huge long-term effects. When fewer people own homes, it becomes harder to build generational wealth. Without that home equity, many can't pass down wealth to future generations, which only widens the wealth gap. Declining home ownership also hurts local economies. Homeowners are more likely to invest in their communities, support local businesses, and fund schools. If renting becomes the norm, it could lead to lower civic engagement and weaker community bonds. On a broader scale, a shrinking middle class means slower economic growth. When people can't afford homes or start families or even buy basic goods and services, businesses struggle and economic progress stalls. To fix this, we'll need some bold changes, like affordable housing. The government needs to push for more affordable homes and regulate corporate and real estate investments to keep prices in check. Raising the minimum wage and adjusting salaries for inflation could also bridge the income gap. And then tax reform. Policies that tax the ultra-rich could actually help fund programs that give more people a chance to move up the economic ladder. And then there's addressing the student loan and healthcare costs. That could also free up cash for more people to invest in their futures. Without these changes, the American dream as it once envisioned will continue to be out of reach for most people, because for many it already is. The idea that anyone can achieve financial security just by working hard is just becoming harder to believe. Rising costs, stagnant wages, and policies that favor the rich have left a generation struggling to stay afloat. And if things don't change, the American dream won't just be difficult to reach, it'll actually be impossible. Let me know what you think below. What needs to happen to save this idea? And while you're at it, make sure you subscribe for more videos like this.